Okay, this is a video on the state of the swing trades for us and why it's so difficult for them, to make money on them of late, really since February when we had the big pullback. The SPY we see, which is the obviously the main market we're trading. This is where it really started to occur for us here when this big first pullback at the end of March. Well, here actually at the end of January, when we started this run back here, when we called the start of the bull market, the Santa Claus rally. I said, look for this to end, somewhere around the end of February. First crack was at the end of January, then the end of February, we got another big pullback. Yet the SPY is in this huge rising channel. And so it's perplexing. And this is what we're going to delve into. But it's perplexing why we had this, 60 and 70% sell-off on the growth stocks. Yet the main market continues to trend much higher. So there's a few things going on here. First of all, let's talk about the bottom of the bear market here. We called this here April 7th. We said this is the start of the new bull market. And we had a huge move, obviously. In this area here was difficult. The swings was very difficult to trade them. We didn't get any follow through. But from there, a couple of pullbacks. But then again, at the start of the election, again we said this is the next phase is going to start, and huge moves for us. Why? Well, every boat floats in a rising tide. So when the markets are this strong and they're going up, you get follow through and you get exuberation, and exhilaration in the market, where people will just buy and they won't think about value. Just because markets are going up, they'll take a position. And so we capitalized on that by getting into these swings with the chart patterns that we take, and when we got good continuation in those chart patterns here and then here. But then something changed in here at the end of March, end of February, end of January, early March, end of February. And what happened was the long end of the bond market started to go up as the economy started to recover. And inflation was starting to rear its head. Now, we did get the Yellen Powell buy the dip call in these areas where they said inflation is transitory. It's not going to be, and we're going to keep interest rates at zero. But the market didn't believe it, really, and we had these, and so we get a rotation out of growth stocks into value stocks. And the reason for that, it's a very complicated economic Nobel Peace Prize, or Nobel Prize in economics to explain it. But in rough terms, what happens is the market has to then decide, and the massive calculations on the income stream from earnings, future earnings versus risk-free 30-day T-bills, and the relationship of that to the long end of the bond market versus stocks that may or may not have any earnings, which is the growth stocks, for a long period of time. And so the risk, there's a big risk in owning growth stocks, because not that there's a big risk in owning the growth stocks. What the risk is that the risk-free, the ability to make risk-free income or next to risk-free income becomes greater than the income stream potential from the growth stocks. So this may sound fairly esoteric, But it just suffices to say that there was a rotation out of the growth stocks and into different sectors, into the value stocks for one, but also a rotation out of these high-tech semiconductor biotech stocks and into infrastructure stocks, because not only was the long end of the bond market going up, and so people were exiting the growth stocks and into the value stocks, but also the economy was starting to open up, and the government, the feds, were talking about massive stimulation in infrastructure projects. So you see a big move in the retail sector, which we've seen, as well as infrastructure plays, the commodity plays, all very strong. The steel stocks, copper, the building, the nail was an absolute monster trade for us, which is the building ETF. So what does that mean to us? For us, well, so what happens is new stocks take over that also make up the S&P. Let's go back one step. So the FAANG stocks, which is 15% of the S&P, they go sideways. Look at these stocks, massive consolidation here, in here. Google's up a bit. Microsoft, Netflix, Nvidia. Nvidia is the big one. Look at this massive consolidation. So no real movement. But they're not going down, so they don't drag the S&P down. They're not going up, so they don't add any impetus to it, but they don't go down. So they're not really dragging on the S&P. But the other stocks that make up the S&P continue to trade higher, the big names. Caterpillar, just continues to. This is the best example because this is a big infrastructure play. John Deere and Company, also big construction makers. GVA, engineering construction. Look at the nail. Now it near the top here, it did pull back, but massive move really from 42 to 120. So a rotation out of the sector that we were trading. And so we trade high beta stocks. And there's no better indicator for the stocks we trade than this ARK Innovations. These are the stocks we trade. This thing came from 160 down to, call it 100, a 60% pullback. No, 60 would be 45, about a 45% pullback from 160 to 100. And because these are the stocks we trade, the beta, they're the big movers. Look at she bought, started this at 33 and it went to 160. Because that was the growth stocks were in vogue and the biotechs were massive, the tech stocks. Tesla went from, this is post-split, $70 to $900. Huge, massive move in tech stocks. Now backing off, it's almost cut in half. 550 from 900. 35%, no, 42%, 43% pullback. So what does that mean for us? Well, so what that means is that the patterns that we trade and we just don't get follow through on them. For instance, or it's sketchy the follow through you get on them. CCIV, just as an example, yesterday we put in this had a double bottom. This was a solid pattern that we followed, broke the trend line, popped up, it surged. It was just going through resistance, so I put a swing on it, and then they whacked it. It comes back. And today there's no follow through on it. Yet other stocks like FUBO, same pattern, V bottom right hand extension, pops up through it. Now maybe a bit stronger. Maybe I was a bit early on the CCIV, but the EV market looked like it was starting to go. Look at FUBO here, popped up through, and now we get follow through with it today. V bottom right hand extension. So it's difficult, and so I'm being cautious on the swing trades until we really get a direction. This one I missed the trade, and look at it, we do get follow through on it. Continues to trend higher. So we are seeing some comeback into these markets. We put a swing on plug. Here's your V bottom right hand extension. Now it's up against the resistance here, but it looks like it's going to go, going to continue to go. So I think we're going to see markets come back now, and we are going to get, and we are going to start getting follow through on these. I think the tone of the market has changed for us. There is still a move into the retail sector, into sectors that are opening up because of the pandemic coming back. But I also think that we're going to see the growth stocks go. And the reason for that, and I believe what Catherine Wood said about this, so it's not necessarily an original idea by me, but, and so I'm not going to take credit for it for the analysis, but what it is even though inflation is coming back on the shorter term, of course it's coming back in the shorter term, you had a government-induced bear market. You had a government-induced bear market where the government shut everything down, and then we struggled through trying to get everything back open. Now it's open back up, so they're flipping the switch back on. So we're coming out of this pandemic, and we're coming out of it very strong. But you have this huge pullback and some economic slowdown. So when things really start to pop, of course you're going to get a big strong resurgence in inflation because everything was so depressed in price-wise. There was no ability to raise prices initially because of the pandemic. Now with the shortages, prices are demand and not enough supply, prices are going up, and we are seeing inflation, but also printing $6 or $9 trillion also devalues the dollar and allows for other commodity, or allows for inflation to come back in. But as the Feds have said, it's transitory. Once an equilibrium comes back into effect, then the Feds are not expecting inflation, around 2% is their target, but they want it to overshoot 2%. And there's a couple of reasons for that. But for us, inflation is not going to be a problem. The bond market is going to, the long end of the bond market may stay high with those interest rates, but that's a sign of a strong economy, and that'll continue allowing markets to trade higher. But the Feds, are not looking, and they're not looking to raise interest rates for a long time yet, too. So we're going to see, and spend another $6 trillion, infrastructure, or their budget is $6 trillion. They want to spend $1 trillion or $2 trillion in infrastructure, which I think is very smart, and that is going to be very, very bullish for markets. But as Catherine Woods has said, it's going to be, the market now is going to become deflationary because there's so much technology being developed in the AI, digital wallets, that and prices are going to continue to come down and down and down, and that's deflationary. So inflation is not going, so we're not going to see hedges against inflation. We're going to see growth stocks come back big, and we're going to, we're going to see again this bull market continue to trade higher, and we are going to start to really capitalize on our swing trades. I know it's been a very tough few months. Personally, I gave back huge amounts from the swings that we did, but I firmly believe that we're just about to start again, and things are going to open up, and the markets in the high beta stocks that we trade are really going to start to perform.